Welcome to The Explainer. Today we're digging into the huge, and I mean huge, upcoming IPO from Meesho. They're an e-commerce giant in India, and they're about to go public. The twist? They're asking for billions of dollars right after losing billions. So how on earth does that work? Let's get into it. All right, so this is the big question, isn't it? A billion-dollar IPO from a company that just lost billions. It sounds kind of crazy. But there's a story here, a method to the madness, if you will. And that's exactly what we're going to unpack today. Okay, first things first. To really get what's happening with this IPO, you've got to understand what Meesho is all about. It's all about them tapping into a truly massive market. So here's Meesho's secret sauce. They're not trying to be the next Amazon, not at all. Their whole game is connecting millions of small local sellers, the ones in smaller cities and towns, with customers who are super value conscious. And their big hook? A zero commission model. That's right, sellers don't pay a cut on their sales. It's a huge deal for them. So Meesho isn't holding any inventory. They're basically a giant digital marketplace, and they make their money from other things like ads and logistics. And just look at this number. It really gives you a sense of the scale we're talking about. Even with that zero commission model for sellers, their operating revenue for the last fiscal year was almost 9,400 crore rupees. We're talking well over $1 billion here. That just goes to show you the massive volume of transactions happening on their platform.
All right, so now that we know what they do, let's get into the nitty-gritty of the IPO itself. Let's look at the key details.
So here are the core numbers you need to know. The offer is open for just a few days, from December 3rd to the 5th. The price they're looking at is somewhere between 105 and 111 rupees per share. All in all, they're hoping to raise about 5,421 crore. But here's the really important bit. That fresh issue of 4,250 crore, that's brand new money. It's not going to early investors cashing out, it's going straight into the company's bank account to fuel their next phase of growth. Which, of course, leads to the next big question. What are they going to do with all that cash? Over 4,000 crore is a lot of money. Let's follow it. And they've actually laid out a pretty clear roadmap. This isn't about paying off old debts or anything like that. Nope. This is all about growth, pure and simple. A huge slice of the pie is going straight into their tech and cloud infrastructure, to make sure the platform can handle even more traffic. Then there's another massive chunk for marketing and building the brand. And look at this. A good amount is set aside specifically for hiring top-tier tech and AI talent. It's a massive bet on getting bigger, smarter, and faster. Okay, so this brings us right back to where we started, to that big contradiction. You've got this incredible opportunity on one side and some pretty serious risks on the other. It's the classic bull versus bear case, the ultimate investor's dilemma. And this really lays it all out, doesn't it? On one hand, you have the bull case, the reason to be optimistic. You've got this massive scale, targeting markets nobody else was really focused on. They're growing like crazy. And that asset-light model where they don't own inventory, that's huge. It lets them scale up super fast and cheap. But then there's the other side, the bear case. They're still not profitable. The competition in this space is absolutely fierce. And let's be honest, trying to manage quality control with millions of tiny sellers, that's a logistical nightmare waiting to happen. And just to put a big, bold underline on that unprofitable point, here's the number. A net loss of almost 4,000 crore rupees last year. Now, to be fair, the company says a big chunk of that was a one-time thing related to moving their headquarters, but still, that is a huge number, and it's something any potential investor has to be looking at very closely. Okay, so finally, let's take a peek at something a little different. It's an unofficial indicator, but everyone watches it to gauge the hype around an IPO. We're talking about the gray market. So before I show you the numbers, we've got to be clear on what this gray market premium, or GMP, actually is. It's not official. It's basically an unregulated, unofficial market where people trade IPO shares before they're even listed. Think of it as a barometer for the initial buzz or demand for the stock. It's all about the hype. And right now, the gray market for Meesho is definitely buzzing. The top end of the official IPO price is 111 rupees. But in the gray market, people are trading it at a price that implies a value of around 144 rupees. That difference, that premium of about 33 rupees, suggests there are definitely some eager investors out there who are willing to pay more to get in early. But, and I really have to stress this is a huge but. The GMP is not a crystal ball. It's just sentiment. It's hype. it is absolutely not a guarantee of how the stock will perform once it actually lists. It's a fun number to look at, for sure, but you have to take it with a massive grain of salt.
So, when you boil it all down, that's what this is. Meesho is making a massive all-in bet on India's next billion shoppers. They're choosing growth and scale now over profits today. And the real question, the multi-billion-dollar question, is, are investors willing to make that same bet? We're about to find out.